Hey guys, welcome to another Monday morning update with Steffani, Rozella over in Spokane. Looks like you're in Deer Park today, ladies. Is that correct? And it looks sunny.
Yep, you are correct.
You wear the sunglasses look very well, ladies, no doubt.
Thank you.
Okay, so we were talking earlier about some economic data that got released, and I'm going to show some slides here that will help understand it. So what you're looking at, ladies, is what's called a yield curve. And a yield curve is a graph that you're looking at there that shows the difference between the yield on treasury bonds, typically in particular. And typically what happens when you have a normal yield curve, like you're looking at on the screen right there, is when you have a short-term bond, and the shortest term you can get a treasury bill at is 30 days, 1 month. The longest is 30 years, a long further out there. When you get a short-term one, the yield that you get on that bond is lower than for the longer-term one. That's called a normal yield curve. So if you're going to wait a long time, you want to get a better yield on your investment. And the significance of this is that the 10-year treasury bill is very highly correlated with 30-year fixed mortgages. And the reason for that is because most 30-year fixed mortgages last between 7 and 10 years these days. And so that's why there's a close correlation there. And you would expect if you had a shorter term duration, like a 5/1 ARM, a 5/1 ARM is an adjustable rate mortgage, which is fixed for 5 years, and then it starts adjusting, that the rate would be lower because it's also correlated, tied more closely to a 2 or a 3-year treasury bond. But what's been happening over the last 2 years is we have what's called an inverted yield curve, and that's what that looks like. In an inverted yield curve situation, the yield on the short-term treasury bills is higher than the long-term. And that translates over into mortgage rates, which is what we care about. And so the adjustable rate mortgages, the 1-year adjustable, the 3 and the 5 and the 7 are all higher interest rates than 30-year fixed mortgages. So no one has been doing adjustable rate mortgages now for at least 2 years. And that's the reason why. The interest rate is higher on the short-term stuff than it is on the higher. So you'd get a 30-year fix if that was the case. Make sense so far?
Yep.
Okay. So what happened as of this recording, which is the second week of September, is that we now have an uninverted yield curve. It doesn't look quite as uninverted as that one, but it's starting to look a lot better than that one, so that short-term rates are now starting to have a lower yield than long-term rates, and that has some interesting repercussions for the economy. For one thing is, this is a little graph that shows you yield curve inversion. When it ends, what's happened. So there's 5 periods there from 1980 all the way through 2007 when there was an inverted yield curve, and then the inverted yield curve ended and it became more of a normal curve. And then months later, in 1980, the bottom one, you can see 3 months actually earlier than that, there was a recession. And in October of 89, 2 months earlier than that. So it's tied very closely to that time period. And the last 3, you can see within 4 to as long as 13 months later, there was defined as a recession. And that's been very accurate. So economists like to look at the inverted yield curve. And when it comes back to an uninverted situation, they anticipate that there will be a recession. It doesn't mean for sure there will be, but certainly historically speaking, it's been very, very accurate. However, the Fed has been trying really hard, and you know this from our previous conversations, to do what's called a soft landing. That means not raising interest rates so fast and too high that it really does cause the economy to go into a recession. And they may or may not achieve that. A recession, technically, by the way, guys, is when you have 2 quarters in a row where there's negative growth with gross domestic product. That's officially what they typically serve as a term as a recession. So the question is, now that we just did an inverted, do we have a recession coming our way? So that's kind of mixed news there. At the same time, I wanted to show you what the rate changes that the Fed has been doing is expected to do with the economy. So the highest the Fed rate has gotten is 5.5%, and the futures market has it down at 3.7%. which is 1.3% lower than it was from the high. It's anticipated to continue to go down further. And historically, the 10-year Treasury, remember the 10-year Treasury is tied to mortgage rates. That's why we focus on it. Falls 1.5% from the first cut in interest rates to the low of what it would be. And if that was the case, when the Fed cuts rates next week, and it cuts the short-term rate to as much as 3.7%, the short-term rate, federal funds rate, could get as low as 2.2%. Now that's a lot of numbers, I get it, but here's what's important to know about that. The spread between the federal funds rate and 30-year fixed mortgages is somewhere around 2.8 to maybe 3%. So that means that you could add 3% to that 2.2% that you see there, and that would interpret 30-year fixed rates to be down at 5.2% potentially. Very, very low compared to where they have been. So that's kind of like good news for the economy.
I would agree with that.
Yeah. So there is actually a futures, I'll call market, that you can look at, that the stock market looks at and investors look at, and they anticipate what the federal funds rate is going to do over time. And the blue line is the most current expectations. Above that, the line is what they thought 30 days ago. And notice now that investors believe that the Fed is going to lower rates a little more than what they thought 30 days ago. Also notice that it's a very gentle curve from our current Fed rate of over 5% down to potentially as low as the 3% rate we were just talking about. And that's going to take about a year and a half. That goes out to July 2026. So actually it's about a year and a half, a little bit more than that from now away. So what that means is we would anticipate that mortgage rates will continually come down, and as we've been talking about, probably stimulate the market so that people are interested in buying homes. So here's the kind of contradictory data. If we go into a recession, typically what happens is people don't buy as many homes because there's not as robust economy, and a lot of people don't have as much work as they did, so there's not quite as much demand, and hence there's not quite as much real estate activity. However, if you have lower interest rates, especially if they get down in the below 6% range, that tends to stimulate the market and you have more activity. So let me pause and ask you guys what you think about that. Do you believe the data, or which do you believe more, and what do you think is going to happen with the market?
Well, obviously those do point to a recession if, like, in our future, possibly. It doesn't look hopeful for it not to be. However, I like your graph here that dictates that our interest rates are going to be low enough to kind of stimulate that economy. I think we still have enough of a market, like a housing market in our area, that I think our particular market will be good and will hold strong just because of that. But I do think that those numbers show and maybe dictate that some areas might not have a great housing market, but I'm hopeful for ours just because of how robust and growing ours continuously is.
I would agree with that.
Okay. So I think you really hit a good point, Rozella, and that is that real estate is very locally based, and what happens in different areas can be very, very different because the economy in different towns and different regions is a lot different. So that's why I like to get you guys' inputs. This is all national data that you're looking at here, of course. A few more slides, we can comment on them. There's a gentleman who we like to follow. His name is Todd Ballinger. He has a really interesting website for loan officers and economists to look at. And he has this U.S. Consumer Real Estate News Sentiment Indicator. You see the little white arrow there is currently in the 4.7, 4.8 range, in between 4 and 5, and it's not very happy face there. So the sentiment isn't really positive. However, you'll note in the bottom there, it's an improvement from the prior week. So it's coming the right direction. Mostly, Todd says that's because lower rates and people are expecting that to continue in the future. So overall, not real positive thoughts for the consumers, but come in the right direction. Any thoughts on that?
No.
I think there's still things that will come into play with this year in particular remaining to give an accurate
There's too many things.
assessment on the yay or the nay. I would agree with that one, like, not a big improvement. I think
If we're
I would say
going week to
neutral.
week, I guess, yeah, that makes sense. Nothing big has happened in the next week, but if we're going month to month, then I think maybe that could go a little bit differently.
Fair enough. Agreed. Here's a couple more for you we can chat about. So you can see, you know, this data, the blue is 2023, 2024 is right next to that. And you can see that existing home sales haven't quite met what 2023 did. And I think that's indicative of what you shared in one of our videos just some time back. Sales are a little off for 2024. Inventory is higher than what it was a year ago. So there's more houses available for people to take a look at and make an offer on. However, with that mixed data, Americans are feeling better in their future. They think they're in better shape to reach their financial goals than the generation that came before them. So you can see that 60-some% of Americans, depending on what age range we're talking about here, believe that the younger generation will be better off financially than the previous generations. And you guys are pretty young. How do you feel about that?
I don't feel accurate at all. Yeah, are we referring to the 20-year-olds, 30-year-olds, or 40-year-olds? Because I think every one of those is going to give you the same answer of, heck no, they're not making it easier. Do you know how much credit card debt 20-year-olds have right now? It's insane. Do you know how much school loans and student loans, like the debt that they have is insane.
Well, there you
And
go.
the interest on paying it off is also insane. It's zero.
The future generation, though, do you think that they're gonna go into as much debt?
No,
I think
I don't know that it's going to be an option. I think the ones before it are going to ruin it for them. They're not going to get that option. Nothing to have.
All right.
Seems like.
Well, you're certainly not as optimistic as that study would indicate, are you, Rozella?
No, sorry.
Who did this?
Stephanie, any thoughts?
Who'd they
Yeah,
ask?
I think that the younger generation that's probably like just now hitting the 18 to like mid-20s, they're probably not going to get into as much debt potentially just because of what they keep hearing. But I do think that they're also getting very creative with how they don't go into debt.
Maybe.
Okay. Maybe they're a little wiser.
What's that?
Are they a little wiser?
I think their options are different.
Yeah. And maybe wiser. I don't know if I could say that. I mean, sure.
Okay.
Aren't we all always wiser than the elders? Isn't that
Well,
what
we
we're
all
calling?
think we are, at least, that's for sure. Yeah. All right, I'll move forward here. I know you guys are dog people, so the question here is, do dogs really look like their owners?
I hope not.
Well, I think in that case, it holds true. What do you think?
That one, absolutely. But I put my dog on a diet this winter because she got a little hefty.
Well, I throw that slightly in, of course, for levity's sake, and I know you guys are dog individuals, but there you go. There's some economic data for you. It's mixed bag, some positive, some negative. It still needs to be played out here.
Awesome.
Comments, questions on any of that?
I don't think so. I'm eager to see how it goes, though.
Yeah, agreed. Along for the ride.
Very good. Well, I wanted to share that with you guys today. Thanks for your time. As always, it's always a pleasure.
Yes,
Thanks, John.
thank you.
We'll see you next time. Bye-bye.
Yeah, bye.